Welcome to the video. If you're earning a high income with low living expenses, you hold a powerful advantage. In this guide, I'll show you a simple, proven, 3-step path to build long-term wealth with minimal complexity. We'll focus on maximizing tax benefits, automating savings, and using broad, low-cost index funds. We'll also cover critical concepts like compounding, dollar-cost averaging, and tax efficiency. Finally, this video includes a quick quiz to reinforce learning and a clear action plan. Let's get started. The biggest mistake high earners make is overcomplicating their financial systems. Complexity leads to inconsistency, and inconsistency destroys compounding. Your edge is a high savings rate and a simple, automated investment plan that runs in the background for decades. Here is today's agenda. First, we will reframe the problem by contrasting trading with investing. Next, we will walk through the 3-step strategy. Then, we will cover the critical concepts you must understand to execute. Finally, we will consolidate your action plan and test your knowledge with short quizzes. Short-term trading can be exciting, but it is often a distraction from reliable long-term wealth creation. Historical evidence shows that passive, low-cost index funds tend to outperform most active managers over long periods. Your goal is to design a system that compounds without your constant attention. That means avoiding unnecessary trading, minimizing fees, and sticking to a diversified, rules-based plan. This flowchart depicts the entire strategy. You start by maximizing tax-advantaged accounts. Then you automate your after-tax investing, and finally you choose broad, low-cost index funds. There is a reinforcing loop from keeping expenses low to increasing your savings rate, which accelerates your time to financial freedom. The last note emphasizes staying the course with dollar-cost averaging, disciplined rebalancing, and tax-aware decisions. Your first priority is tax optimization. Maximize contributions to your 401k plan and take full advantage of any employer match. If you have access to a health savings account, contribute the maximum since HSAs are triple tax advantaged when used for qualified medical expenses. With high household income, you may be above the direct Roth IRA contribution limits, which is why a backdoor Roth strategy may be necessary. Be cautious with high-fee investment products and avoid mixing insurance and investing unless you fully understand the trade-offs. Backdoor Roth involves making a non-deductible contribution to a traditional IRA and then converting that amount to a Roth IRA soon after, ideally before any earnings accrue. This minimizes the tax impact. It is important to file IRS Form 8606 to track your after-tax basis. Be aware of the pro rata rule, which can cause unintended taxes if you have other pre-tax IRA balances. Consider rolling pre-tax IRA funds into an employer plan if feasible to avoid the pro rata issue. These are 2024 contribution limits for reference. Always verify the latest IRS limits before contributing, as they can change annually. Note that Roth IRA income limits may require a backdoor Roth approach for high earners. Once your tax-advantaged accounts are maximized, set up automatic transfers to your taxable brokerage account. Schedule them the day after payday to avoid timing mistakes and decision fatigue. Use automatic investment settings to purchase your target index funds consistently. Whenever your income increases, raise your automated contributions accordingly to maintain a high savings rate. Here is an illustrative monthly breakdown. If your household income is roughly $230,000 or more, aim to keep living expenses low and direct as much as possible into retirement accounts and taxable investments. The example pie chart shows a high savings rate by allocating significant portions to retirement and taxable investing. As you receive raises, increase the automated investment amounts to maintain or grow your savings rate. Your core holdings should be broad market index funds with very low expense ratios. A common approach is a 3-fund portfolio consisting of a total U.S. stock market fund, a total international stock fund, and a broad U.S. bond market fund. Avoid individual stock picking and thematic fads. Rebalance periodically based on a schedule or threshold rather than emotions. This mind map lays out the 3-fund portfolio components. The U.S. stocks branch represents a total market approach covering large, mid, and small companies. The international branch adds diversification across developed and emerging markets, which also introduces currency diversification. The bonds branch provides a stabilizing role and helps manage interest rate risk. Supporting notes emphasize annual rebalancing, keeping expense ratios low, and embracing simplicity to enhance consistency. Dollar cost averaging means investing a fixed amount on a set schedule, regardless of market conditions. This turns volatility to your advantage by buying more shares when prices are lower and fewer when prices are higher. Consistency and discipline are more important than trying to time market tops and bottoms. Quiz time. The question is, which approach best supports long-term wealth creation for high earners with low expenses? Option A, day trading individual stocks and futures for quick gains. Option B, buying hot thematic ETFs when they trend on social media. Option C, automating contributions into low-cost, broad index funds. Option D, concentrating all savings into one so-called sure thing stock. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Automated contributions to low-cost, broad index funds align with the principles of diversification, low fees, and compounding. This approach is consistent and scalable, which gives it a high probability of success over long time horizons. Tax efficiency involves placing more tax-efficient assets like broad U.S. stock index funds in taxable accounts and holding less tax-efficient assets like bond funds inside tax-advantaged accounts. Exchange-traded funds can be advantageous in taxable accounts due to their structure. Tax loss harvesting can help offset gains, but you must avoid wash sales by respecting the rules. If you have an HSA, consider investing the balance and saving receipts for future qualified reimbursements. This comparison highlights key differences. Trading focuses on short-term moves and demands ongoing attention, often triggering higher taxes and emotional decisions. Investing focuses on the long term, uses automation, and emphasizes tax efficiency and low fees. A rules-based approach leads to higher consistency, which is essential for compounding. Use this checklist to challenge your plan. Understand how compounding and fees impact long-term outcomes. Ensure your system is automated and simple. Prioritize tax-advantaged accounts. Select low-cost diversified funds. And rebalance based on rules rather than emotions. Here is the second quiz question. What is a prudent first move after maxing out your 401k and HSA as a high earner? Option A, pick individual tech stocks. Option B, automate transfers to a taxable brokerage and buy low-cost index funds. Option C, keep cash idle until the market feels safer. Option D, buy options to gain leverage. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. After maximizing tax-advantaged accounts, consistently funneling money into a diversified, low-cost taxable portfolio via automation is an effective next step for long-term growth. Here is a concise action plan for the next 30 days. In Week 1, identify your available accounts, contribution limits, and select your core index funds with a target allocation. In Week 2, set your payroll deferrals, open any remaining accounts, and prepare the backdoor Roth process if needed. In Week 3, set up automated transfers to your brokerage account and enable auto-invest. In Week 4, draft a personal investment policy statement and pick a fixed annual rebalance date to enforce discipline. This diagram illustrates a sample investment policy statement structure. It includes a time-bound objective, a model allocation of 70% U.S. stocks, 20% international stocks, and 10% bonds, an automation plan for contributions, and explicit rebalancing rules. The key is to document constraints, such as no individual stock selection, and maintaining very low fees. Customize these parameters to your risk tolerance and time horizon. This video is for educational purposes only, and does not constitute financial, tax, or legal advice. Everyone's situation is different, and you should consult a qualified professional before taking action. Verify all contribution limits and rules with up-to-date sources. To recap, maximize your tax-advantaged space, automate everything you can, invest in broad and inexpensive index funds, and commit to a long-term, rules-based plan. Understanding compounding, dollar-cost averaging, and tax efficiency will reinforce your success. Thank you for watching. If you found this helpful, please like the video, share it with someone who might benefit, and subscribe for more content. Leave your questions and your 30-day action plan in the comments below.